Aloha, this is Joshua Hayes at BigWaveTrading.com coming to you with this weekend's, I guess, weekend wrap up, I guess. Well, anyway, as we can see here, a lot of maybe, I don't know, I don't think it's good news, whatever. The bailout package has gone through or whatever. And everybody's trying to celebrate and calling a bottom in the market. But you got to remember, on the best follow through days, which this day is not, but it's the most powerful day in the New York Stock Exchange, they take out the white and purple lines. So the fact that we're even looking at calling that day as follow through day is pretty weak to me, and that's why prices didn't go very far and there wasn't much follow through to the follow through day because it's not one of the best ones out there. As you can see, prices on the New York Stock Exchange are steadily below the 50-day moving average and 200-day moving average. And until that changes, there is no reason to be buying stocks, especially whenever I warned most of you to stay away from stocks like Washington Mutual. That's what you get. The stock clearly followed the white line down, could not commit to taking back over the 200-day moving average, which is the purple line. And as you can see, it collapsed all the way from $26 below the white line to its new home of 16 cents that I believe that JP Morgan now has, right? JP Morgan's got these guys now, right? Right. Okay. So now let's go on to the Nasdaq and see how the Nasdaq looks. Let's see if we have anything better positive showing up over here. And we don't. I mean, we do. We do have lows here. It's nice that we had a big move there on huge volume as possible support, and then a big up day. But the weak close on that day was pretty unconvincing, and then followed by a 4% loss tells you that things aren't going too well. And the losses continued, and there's that follow through day that pretty questionable right there, 1.43% with volume barely above the day before, and as you can see, clearly below average. And that's why you have no juice on Friday, and the market pretty much just did nothing. It did nowhere as traders are basically just waiting out this whole environment, as this is a very negative environment to be long in. And I suggest that most of you, if you are not already in cash, or be in cash or short. If you're a good shorter, then good. I mean, I've had two great shorts work out. Neither one are huge because I'm more committed to having cash on hand right now instead of being short, because the action, the stocks are so volatile. I cannot get clean setups. I mean, when the S&P 600 takes off on a 6% move, and then another 3% to combine on a 9% move, and then comes down 4%, and then down another 1.3%, and down another 1.67% to have a 3-day move of 7%. I mean, it's kind of hard to get a gain on this market. And when you see a chart like this, once again, the price is below the 50 and 200-day moving average. The prices can't hold on to the averages. It's been in a long downtrend. This is just not a market to be long, folks. The market to be long, folks, as you can see clearly, was 2003 all the way through 2007 until around the summer. And then that's when it was time to get out. And even then, we did have one last rally here at the end before it all fell apart. So right now, there's just nothing to do. The only longs I can find are medical stocks, biotech stocks. I've got a couple of them, but I can't really find them. The overall indexes look horrible, and I want to go to the leading stocks because I think that right now is more important to show you than anything else after this Dow Jones Industrial Average. As you can see, the Dow Jones Industrial Average is doing its best to try to bottom also. But once again, notice that your follow through day, that everybody wants to call it a follow through day, is coming on volume that's below the 50-day volume average. I mean, it's not very powerful. Look at the week close. Powerful follow through days would look like this and would be taking out the 50 and 200-day moving average. They're not like that. They're not weak and wimpy like that. They don't look like that. The most clear evidence of this market still not being buyable for me, and which means it could be buyable. I mean, obviously, if charts sharpen up tighten up, straighten out, and new leadership of real companies with real sales and earnings growth shows up, then I'll become a committed bull again. But I have a feeling that this is going to be a long bear market. And that feeling comes from looking at the leading stocks in my IBD charts. And whenever I look at like the IBD 100 index, which is full of nothing but leading stocks, I mean, look at this. Look at this weekly chart. Look, this weekly chart is a broken down chart. After coming up here, excuse me, it rolls over, tries to make a new high again, but can't, and falls. And if you fall, and if you see here, you can see plenty of distribution days and the red markings here. And in the blue markings, you can notice weak closes, which means that they did not close strong, which means that there was inherent weakness throughout the day. And as you can see, the relative strength confirming the weakness of this whole pattern. And that's just the IBD 100 index. When we go to another IBD index, which is the IBD 8585, it is confirmed even more. And it's also another ugly index. Oh, that's the weekly. Let's put up the daily to really show you. And just look at that since the top. It just continues to get lower and lower and worse and worse. It tries here to fight back above the 200-day moving average, but it sure can't do that. And it breaks down right below it, and it rolls over. And it keeps rolling over. And until this shows up again, there's no way I'm buying stocks here. And in fact, I am short certain stocks like Research in Motion, which I will show you on a weekly now. And here's a daily of the IBD chart, and that's where the price is. Do you see this ugly action? This is where I like to look at IBD charts over my charts, is that I can really see how just ugly the action in the markets is. And I mean, look at Research in Motion go on its way towards the top. And then as you can see, as it makes another top, volume gets lower, and distribution days mount up, and now it's cracked. Most people are now going to probably say it's a bargain, come and get it. But with 524 mutual funds in there, and with earnings and sales slowing, and estimates being lowered, there is no way I feel confident in this market at all. I just do not like to see leading stocks being crushed like this, and then like to see my leading indexes looking like that. There isn't much more to that this week. It was a dead Friday. As you can see, volume was well low, and it's obvious that things look very bad out there still, and that it's just not time. It's just not time. I mean, there's no other way to put it. It's time to make sure you hold on to your cash, because if you don't, you could end up in a Washington Mutual, or I believe they still have the Freddie chart for me up here, or a Freddie Mac crisis, which they're hoping will still exist. I'm sorry, any stock that hits 26 cents that used to be a $40 stock, or I don't even know if it was, but any $28 stock that hits 26 cents, I'm sorry, it isn't coming back. And as you can see right here, as it gets towards the 50-day moving average, nothing happens. So I know it's pretty pessimistic out there, but gosh darn it, every bear market turns into a bull market. So eventually this will have to end, but I believe we probably have a lot more pain in store before it's over. If I can get some great rallies in between, that would be fantastic. I would love to see better action on Celgi, better action on Macy. If these charts would just keep going up. Look at this, failing the 50-day moving average. Now it's got to hold the 200-day. If these charts with this kind of patterns can just hold up, I might have a little bit more faith. There's XSI, the one that I've been long since June and added heavy to on the August breakout. I mean, if these charts can just hold up for us, we still have chances of making money in this market. But right now, it is very difficult, and if you're losing a lot of money, take the money out. Go to cash. There's nothing wrong with it. The United States dollar, I mean, no matter what people are saying about it, it's not as horribly weak as people think it is. Yes, it's still in a downtrend that came off 2006, 2004, but it's having its strongest rally back. It's moved over the 50, 200-day moving average whenever I first got bullish on it, as it crossed up here, and it came down to the 50-day moving average and is now dancing along it higher. Hopefully that keeps up, and hopefully things turn around. I'm not quite too sure, but I would like to be more pessimistic than or optimistic than pessimistic right here. But currently, the way that the charts look, unless they start looking like the United States dollar, you need to go ahead and just stay out of this market, or if you're experienced, look to be shorting. This is Joshua Hayes at BigWaveTrading.com coming to you with today's market wrap. Aloha.